Would you believe me if I told you most people lose money in the stock market before they even buy their first share? Not because the market crashed, not because they chose the wrong company, but because they went in with no real strategy. They bought a stock because it was trending online and because someone on social media said it was about to explode, or because a friend told them it was the next big thing. And by the time they bought in, the people who started the hype were already cashing out. At the same time, there are investors quietly building serious wealth every year. No hype, no gambling, no emotional decisions. Just smart, disciplined investing. So what do they know that most people don't? In this video, I'm going to show you how to effectively invest in stocks using proven principles that have stood the test of time. We'll also touch on Warren Buffett's investing framework and use some of those ideas as a guide to understand what actually works. Warren Buffett is touted as the greatest investor of all time, and I'd be doing you a disservice if I didn't mention his strategy. And by the end of this video, you'll not only know how to look at stocks the right way, but how to avoid common traps, and how to make smarter investment decisions with confidence. And trust me, once you understand this, you'll never look at stock investing the same way again. Let's be honest for a second. Most people treat the stock market like a casino. They go in gambling all their hard-earned money away like it's a $10 slot machine. They guess. They chase trends. They panic when prices drop. They get greedy when prices rise, but real investing is different. When you buy a stock, you're not just buying a ticker symbol on a screen. You're buying a piece of a real business. And technically, you're an owner, even if it's just a small piece. That one shift in mindset can completely change the way you invest. So instead of asking, will this stock go up next week? You start asking, how does this company make money? Is this business growing? Does it have an advantage over competitors? Is it financially healthy? Would I be comfortable owning this company for the next 5 or 10 years? That's how successful investors think, and that's where you should start too. Step 1. Understand the business. Before you think about buying a stock, ask yourself one simple question. How does this company make money? If you can't explain it clearly, that's a warning sign. Take Apple, for example. Apple makes money selling iPhones, computers, wearables, software, and services through a tightly connected ecosystem. Microsoft makes money through software, cloud computing, business tools, and subscriptions. Coca-Cola sells beverages globally through one of the strongest distribution systems in the world. These are simple businesses with clear revenue models. Now compare that to someone buying a random stock they saw trending online without understanding anything about the company. That's like buying a restaurant without knowing what food they serve. Warren Buffett has always emphasized investing in businesses you understand. And it makes sense. Because if you don't understand how a company wins, you won't know when it starts losing. Step 2. Look for a competitive advantage. The best companies usually have something that separates them from everyone else. This is often called a moat. A moat is a durable competitive advantage that protects a company from competitors. Some examples include strong brand loyalty like Nike or Coca-Cola, network effects like Visa or MasterCard, high switching costs like Adobe or Microsoft, cost advantages like Walmart or Costco, and patents or proprietary technology. If a company has no real advantage, competitors can copy them, lower prices, and take market share. That can destroy profits quickly. Great investors don't just ask if a company is good today. They ask if it can still be great years from now. Step 3. Learn to read financial statements. Now we get to the part most beginner investors avoid. Financial statements. A lot of people hear that term and instantly lose interest. That's a mistake. Because financial statements tell you what hype never can. They show you whether the business is actually strong. There are 3 main statements every investor should understand. First, the income statement. This shows revenue, expenses, and profit. Ask yourself these key questions. Is revenue growing? Are profits improving? And are margins getting stronger? A company can be popular online and still be losing money. Second, the balance sheet. This shows assets, liabilities, and debt. Look at how much cash the company has and how much debt it owes. Can it survive difficult times? And can it continue growing without being buried in debt? Third, the cash flow statement. This shows how real cash moves through the business. And cash matters. Some companies can report accounting profits while burning through real cash behind the scenes. That's a major red flag. One of the reasons why many investors love investing in Apple is largely due to its large cash reserves. Cash will always be king. If you learn how to read these three statements, you'll already be ahead of most retail investors. Step 4. Why hype can destroy investors. This is exactly why so many people lose money chasing hot stocks. They buy stories instead of numbers. They buy excitement instead of fundamentals. Think about GameStop, AMC, and Bed Bath & Beyond. These stocks became widely known as meme stocks and gained huge internet momentum. Some people made a lot of money, but many more bought near the top and got crushed on the way down. But why? It's because hype can move prices in the short term, but in the long term, business fundamentals usually win. If revenue declines, debt rises, and the business weakens, eventually reality catches up. The market can be emotional for a while, but over time, it tends to reward real performance. That's why learning how to analyze a company matters so much. Step 5. Don't overpay. Even a great company can be a bad investment if you pay too much for it. This is where value investing comes in. Value investing is the idea of buying a strong business for less than it's truly worth. Think of it like paying $70 for something worth $100. That's the goal. Investors often look at metrics like price-to-earnings ratio, price-to-sales ratio, free cash flow, return on equity, and growth rates. These numbers help you understand whether the stock price makes sense relative to the business. Warren Buffett became famous for buying excellent businesses at fair prices instead of average businesses at cheap prices. That difference is huge because quality matters. Step 6. Think long-term. One of the biggest reasons people fail in stocks is impatience. They buy on Monday and panic by Friday. That's not investing, that's reacting. Real wealth is usually built through time. Think about companies like Apple, Microsoft, Amazon, or Visa. Long-term investors in those companies went through market crashes, scary headlines, recessions, and volatility. But patience rewarded them. A 10% move in a week might feel exciting, but a 10 times return over 10 years can change your life. That's the power of long-term thinking. Step 7. Focus over chaos. Another Buffett principle worth mentioning is concentration. That doesn't mean putting all your money into one stock. It means owning your best ideas instead of collecting random companies you barely understand. Many beginners own too many stocks, 10 names they never research, 20 companies they can't track, or 30 positions they bought for no clear reason. That's not strategy, that's confusion. A focused portfolio of quality businesses often makes more sense than owning a pile of random stocks. And if you don't want to pick individual companies, broad index funds are still a powerful option and is considered one of the best stock investing strategies. Step 8. Management matters. Never underestimate leadership. A great business with poor management can become a terrible investment. Pay attention to the people running the company. Are they honest? Do they communicate clearly? Do they make smart long-term decisions? Do they constantly dilute shareholders? And do they overpromise and underdeliver? Make it a practice to read shareholder letters and listen to earnings calls. Study how leadership behaves. Management integrity matters more than most people realize. Think about this for a second. Apple's stock soared in 1997 when Steve Jobs returned to Apple after being ousted in 1985. The company was in a decline for many years prior, and my guess is it was due to management. The market reacted and understood the importance of Jobs being the leader once again, and hence why Apple holds the position it has today. Step 9. Where to research stocks. There's a ton of places you can look to get this information, but here's a few sites where you can start. First, SEC Edgar. This is one of the best sites and tools available because it gives you direct access to official company filings like annual reports, quarterly reports, and major updates. And not to worry, everyone has free access. The second is Yahoo Finance. They're great for charts, valuation metrics, financial summaries, earnings data, and historical performance. Many investors utilize this site frequently. And third, company investor relations pages. Many businesses post earnings presentations, shareholder letters, and updates there. The key is simple. Use real data and don't rely only on headlines or social media posts, or that one YouTuber who tells you what the next stock trend is. Here's a checklist you can use for stock investing. Before buying any stock, ask yourself, do I understand the business? Does it have a competitive advantage? Is revenue growing? Is it profitable? Is debt manageable? Is management trustworthy? Is the stock reasonably priced? And would I feel comfortable holding this for years? If the answer is no to several of these, move on. There are thousands of stocks out there and you don't need to force a bad opportunity. Here's the conclusion. Effective investing is not about chasing the hottest stock of the week. It's about buying strong businesses at fair prices and holding them with patience. Always be able to understand what you own. Make sure you study the numbers and ignore the hype. Always think long-term and stay disciplined. Real wealth is not built overnight, it's built steadily. And steady always wins the race. If you found value in this video, be sure to like, subscribe, and comment a stock you're researching right now. And remember, the goal isn't to look smart this week. The goal is to become wealthy over time. Thanks for watching.